The point that I want to get at, and I don't want to bore you, is just looking at their debts, and this is where you go. In the previous year, they had zero. It's now up, but in general, there's more assets than there's more debt. So that's a very good thing. So equity is 1 billion, assets 1.8 billion. So, there's money left over. Okay, so that's the key thing to focus on, and this is the kind of thing that, it takes practice, and you've got to read these things for yourself. But this is what you would focus on. If I had to go through this now in incredible detail and show you my thought process, it would be incredibly boring. But you get the idea, I hope. So now we're going to look at the cash flow statement. Okay, so where you go, cash flows. Cash flow from operations, so that's the first bit. Cash flow from investing, and then cash flow from financing. Okay, so cash flow from operations, net income 51938, which is, where's this cursor now? So I just want to find my cursor. There we go. 51938, which is that. And the operating cash flow after all of these adjustments is actually double. Okay. 114, 74, 108, 88. So it must be some kind of special adjustment that it's actually double. What is it? Depreciation is more. There we go. Assets impairment. So they're adding back what they've impaired. That's one element compared to previous years. Inventories. So in previous years, they had to make a big adjustment for inventories. So in this current year, inventories went down on the balance sheet. So they're taking that sort of cash. Income tax. See, but in general, 108 to 88, 114 to 74. In general, you're looking at about, I suppose, 70% of their revenue turns into cash in the year. So that's a sort of reasonable thing. The revenue turns into cash. That's kind of important. So just high level, revenue turns into cash. 70-ish %. How I get to my 70-ish is 74 divided by 114, 88 divided by 18. I mean, I'm not, you can pull out the calculator if you want, but I'm just sort of in my head getting a sense. Let's just pull out the calculator just to labor the point. So 74 divided by 114, 64%. Okay, not 70. Hey, whatever. 88 divided by 108, 81%. Okay. Point is, it turns into cash, and a big chunk of it. What's next on the checklist? Cash flow from investing to maintain business or for growth. So this is where you would look. So they've bought something. Bought a company, I think. Capital expenditure. And then these smaller ones. So they don't have any note numbers here, but let's just go look for acquisition. Acquisition. Note issued in connection with acquisition. So they bought a brand, Donna Karen. acquisition. Next. Recent acquisitions. There we go. Acquired Donna Karen. Blah blah. So they bought a bunch of brands. So it's in sort of slower time, it's worth sort of sitting there and going, does this make sense for them to be doing? And in terms of their business, their whole business is brands and licensing brands. So it's not like they're suddenly going into selling soft drinks or anything like that. So, but this is something you need to sort of sit and think about in slower time. So this is investing for growth, investing in area of expertise. Okay, fine. And then let's just have a look at the borrowing, which is financing. So long-term loan. Okay. Proceeds and borrows revolving credit facility. So that's essentially an overdraft. 283 plus 11, so that's 383. That's almost 400 million. 465. So it looks like these two lines are there to finance the brand that they bought or the acquisition. So that seems reasonable. Borrowing money to grow. Hey, you can sort of sit in slower time and really pull that apart and think, is that the right thing to do? But these are the two areas that you would look at in terms of the financing. It doesn't look like they're addicted to borrowed money, the way the business is going. Yeah. So these are the points that you need to consider when you're analyzing a company. And I've done it fairly quickly. I'm not going to bore you with my sort of thought process of going back and forward and really trying to understand. But this is the way that you would go about it. This is where you would look to understand the company. You might then look at their investor relations website, where they have all sorts of information and pretty pictures. That's another place you'd go to look and try and understand the company. Ultimately, fill in these checklists. I got to the point where, in my decision, I looked at the low debt load that they had and thought, okay, even though the price fell off. There's another question you would ask yourself: is why did the price fall? So that when I had a look at that, they had their bad year. Even though because of their low debt load, I thought they're going to survive, and then just because of the way the numbers were going, the valuation seemed reasonable, and the stock would come up to the valuation. And it just, as we've adjusted it now, I'm saying it's worth about 37. If you go onto their website, it's come off, and hey, 35.64. So yes, the market seems to be trading similar to with the valuation that we've just quickly come up with now. It did go a bit crazy, and I took advantage of that. But there you go. So, conclusion, I bought it and I sold it. So that's it for G3. So I'll see you in the next video. Cheers.